Let's go and get to our final guest of the program, and it's a good one. Fraser MacLeod from Assurance Partners joins us live from Adelaide. Fraser, good to go and see you there. Another day, another all-time record high. What's not like to like?
Yeah, it's amazing, isn't it, Scotty? Yeah, thanks for having me on again. So, yeah, record highs. We're above 7,500 this week, and we always look at the total return that we can get on markets. We don't get too excited that the market is just hitting a record high. But is there still a bit of value there? There probably is. On our figures, the market might produce, say, maybe 8% over the course of the next year. 4% of that would be income, 4% growth. Nothing really to be terribly excited about, but earnings are still going up in the US and also here. We do have a market which still seems relatively buoyant. We always get little scares and shocks along the way, but is there a big enough reason to be pulling out lots of equities and into cash? Probably not. So there are some interesting things happening over the past few weeks. In that you're right. Iron ore is well down, and whilst you see BHP share price still remaining high. And the earnings of BHP still remaining high. The PE that BHP is trading on is slipping. It's getting lower and lower and lower. So the market's really looking at that, going, well, gee, bit of risk there over the next 6 to 12 months, perhaps.
Yeah, keeping a very close eye on that one, of course. Even from the macro perspective, a lot of people keep an eye on, given the implications for fiscal revenues. Let's get to some of the companies that have been reporting so far. BWP Trust, of course, the Bunnings property owners around the country. It's been, compared to other businesses, really buoyant the last year or so. So many people looking to go and build their houses, renovate their houses. Is that a sign that maybe the top is in and it's time to go and recycle into other areas?
Look, yes, I think so. Bunnings obviously a very reliable business. You would expect it to be a reliable tenant. So the BWP is the listed property trust that owns the bricks and mortar for many and most of these Bunnings stores. So they've got 74 locations across the country, 8 of them in Sydney, around where you guys are. And they pull in, should be around $150 million in rent from a very reliable tenant. The challenge is that they now have the lowest rental growth, really in nearly a decade. In 9 years, it's the lowest rate of rental growth. And that's a big problem. It's a big problem also that they have 2/3 of their leases are going to expire between now and 2026. So that's a real challenge. There's not a lot of growth coming through. They've got a big payout ratio, so a lot they're having to add to the income that is paid out to shareholders. And look, it's looking really expensive. So probably is time to be letting some of these go. It's done okay over the years. If you've held it for the past 12 years, it's gone from, say, $1.50 to $4 odd. But we do have some real concerns over the lease expiries over the next few years. And whilst you've got a very reliable tenant, it's pretty much your only tenant, and that's the real challenge.
Would you go and use the proceeds from any potential sale of BWP Trust and recycle into the traditional fossil fuel energy space? Now, Oil Search Santos at the moment, of course, that was put into the second back pages by that Square and Afterpay deal. Now, we've got the PNG government out today talking about, not entirely certain about the deal themselves. What's your sense as to whether this deal is going to go ahead and whether it actually makes sense?
Okay, yeah. We think it probably will go ahead. It does make sense from the something really for everyone here. That you can scratch your head and think, well, who's really got the best part of this deal? And I would say that Oil Search shareholders maybe just have it slightly, because Oil Search faced some real serious challenges in that it's almost entirely PNG reliant for the future. And now even the merged company is going to be about 40% reliant on PNG, which might cause Santos shareholders a bit of concern, especially amongst the rating agencies. It is probably one of these rare opportunities. These guys are combining and creating Australia's biggest oil and gas company. So from a number one place, so the fair deal from both ends is that if you're a Santos shareholder, you need the oil and gas. You were always short quality resource developments for the future. And if you were an Oil Search shareholder, well, you had real challenges with the quality of the management. Do they have and are they able to execute on the PNG expansion over the course of the next few years? But it's probably the case that the Oil Search shareholders are getting maybe a slightly better deal out of this, because they're not going to be so reliant on PNG going forward. They're piggybacking on the back of Santos' better ESG credentials, and ultimately they're getting more diversification out of the deal, whereas Santos shareholders are not.
So ASA shareholders narrowly get the victory there, gold medal for that particular deal. Let's move along. When I was speaking on Friday to David Bossio, your colleague over in Perth, he was talking about the Sprott Physical Uranium Trust. Now, we ran out of time, but just give us a bit of insight as to what that actually goes and invests in. Is it an active fund? How does it work as the trust structure?
Yeah. So Sprott, obviously North American, they're a massive commodities investment manager. Now they're very experienced. So they have about $13.5 billion in similar funds that are very highly actively traded by institutions and retail on the North American markets mostly. And those funds have previously been investing in gold and mostly silver and a few other commodities. But $13.5 billion is a big number. They're going to be taking that expertise and they are bringing to market their own version of what is going to be the world's largest uranium fund. That fund is going to be investing directly in yellowcake, in the raw material. And it's going to offer at least, for now, it's going to be the most transparent and liquid way to attract new capital. They could build this fund quite quickly to $1 billion fund. That's not inconceivable. And the driver that should have on the uranium spot price could be really quite stark. So that it is, every uranium investor is looking upon this as being the next big catalyst that's going to happen over the next few months. Also the potential for the fund itself to grow even to an even larger audience. Currently, it has a listing on the Toronto Stock Exchange, but they do have the ability to be able to buy for US investors on the Toronto Stock Exchange as well in US dollars, which makes sense because ultimately the commodity is driven in US dollars. But also they have applied for a New York Stock Exchange listing for this fund, and that might take a little while for them to get that across. They probably will get it across the line. If it does, then it opens up a huge market in North America and will really be the only place that North Americans, or the number one place that North Americans would invest if you're an American and you are wishing to get long, safe, reliable, carbon-free baseload power for the future. So it is turning into quite a decarbonisation play, and there's a lot of money on the sidelines to hopefully make use of that.
And it helps to go and spread out a bit of the risk there as well, instead of being single stock exposed.
Yeah, I mean, ultimately, yes, because we can be very focused on a lot of smaller cap names on the equity side of things, but probably a less risky and less volatile way of playing the decarbonisation upside. But it will have huge implications for Aussie equity investors here as well.
Fraser, good chat as always. Hopefully, going to see you very soon. We'll speak soon.
Hopefully, you do make it to Adelaide very soon. Cheers, indeed.
Take care.